Over the past year, we've been bombarded with talk of recession risks, economic slowdown, and looming job losses. Whispers of an imminent downturn seem to grow louder with each passing data release. Yet on Friday, the latest employment figures delivered a jolting reminder of just how sturdy and resilient the American labor market remains. The March jobs report was simply stunning. The U.S. economy added 303,000 jobs, blowing away economists' projections of 200,000 new positions. The unemployment rate ticked down to 3.8%. For those losing faith in the vigor of the recovery, this was a bracing tonic. It seems the relentless strength of the labor market, combined with persistent inflation pressures, has robbed the Federal Reserve of any near-term off-ramp for reversing its campaign of interest rate hikes. The very data that just a month ago spurred rampant betting on imminent Fed rate cuts has instead cast those wagers into doubt. After the release of the blowout jobs numbers, bond yields vaulted higher as traders recalibrated their rate expectations. The market's outlook for how many quarter-point cuts the Fed will deliver this year shrank considerably. Where traders once saw a 2/3 chance of at least 3 cuts by year's end, the odds have been cut in half. Put simply, an economy gaining steam this rapidly doesn't need nor does it merit looser monetary policy anytime soon. And the Fed knows it. As Jerome Powell, the courtly but resolute central bank chair reiterated this week, he needs greater confidence that inflation is headed back down to the 2% target before allowing any easing of financial conditions. Of course, for a White House engaged in the perpetual campaigning that's become endemic to our civic life, the jobs figures are an unalloyed political blessing. President Biden now has tangible evidence that his economic agenda is producing results families can feel in their pocketbooks. He's quick to remind us that over 15 million new jobs have been created since he took office. But on the other side of the same coin lies an inconvenient reality successive presidents and Federal Reserve chairs have confronted before: robust job growth amidst stubborn inflation ultimately demands a difficult course correction. The Fed's very success in generating a hiring boom and maintaining what Fed Governor Lori Logan called a remarkably tight labor market also perpetuates the uncomfortably elevated prices the central bank is striving to restrain. Leading economic voices, like Cornell's Ishwar Prasad, warned that the remarkable strength of the U.S. labor market and the stubborn persistence of inflation leave the Fed with painfully little leeway to slash interest rates soon without risking a revival of the inflation psychology it has labored to extinguish. The path to a proverbial soft landing, cooling prices, without a punishing recession, grows ever more tenuous. Of course, in this era of economic whiplash and dashed projections, perhaps we should expect the unexpected. As the economist Dean Maki notes, despite the blockbuster jobs data, the Fed may ultimately prioritize progress on inflation over labor market conditions when charting its rate path. If price pressures do steadily subside, the central bank may convince itself that cuts are appropriate regardless of the job market's trajectory. Yet that precisely underscores the treacherous path the Fed must navigate between the competing economic maladies of inflation and unemployment. One relentless data point continues thwarting their efforts to adequately address the other. The conundrum captures the essence of our present economic moment: outwardly positive figures shadowed by equally ominous undercurrents. Indeed, in the face of such seemingly contradictory signals, the central bank finds itself in a perplexing bind of its own making. Having achieved their goal of fostering a vigorous jobs recovery, the Fed now seems captive to the very outcomes it manifested. Just as victory can sometimes sow the seeds of future defeats, so too can a central bank's laudable accomplishments paradoxically deepen and prolong the very quandaries it most hoped to resolve. What happens next will reveal much about whether Federal Reserve officials have the perspicacity and fortitude to lean against political and marketplace pressures and stay true to their stated priorities. Do they hold their nerve and keep rates elevated until inflation is comprehensively quelled, risking a spike in joblessness? Or do they blink at disrupting the job market's remarkable vibrancy, inevitably fomenting future inflation flare-ups? This inflection point encapsulates the grand economic dilemmas of our age. Balancing the innumerable crosscurrents shaping growth, employment, and prices defies easy answers or dogmatic adherence to any one economic doctrine. Our prosperity and social fabric rest upon the judiciousness with which policymakers wrestle with these profound trade-offs. On a deeper level, enduring economic health may hinge less on divining some perfect synthesis of inflation fighting and jobs promotion than on fostering a societal ethos that privileges long-term sustainability over short-term bursts of progress. It's a mindset of prudence and nuanced prioritization often undervalued in our increasingly polarized and immediate return-obsessed age. The latest jobs figures remind us that while flashes of encouraging data provide momentary affirmation, true economic stability arises only by confronting harsh choices head-on, even when those choices force us to supplement welcome developments in service of more lasting equilibrium. It's a message our consumerist economic psyche has been ill-prepared to internalize. If the Fed indeed summons the fortitude to hold firm, resisting the siren song of an overheated job market until inflation is durably tamed, it will mark a pivotal test of our capacity for delayed gratification. A patient public, attuned to the bigger picture beyond headline stats, will be critical to allowing this delicate mission to succeed. For now, though, the March jobs report stands as a pointed rebuke to the fatalism infecting our economic discourse. Even after a year buffeted by shocks and headwinds, America's core economic sinew displays astonishing resilience. And yet this heartening reality has quickly become intertwined with the Fed's starkest conundrum, forcing hard choices long deferred. Confronting such paradoxes, not evading them, may be key to leaving a more sustainably thriving economy to the next generation.